Hey everybody, welcome to Stein Wealth Advisors. Today is March the 3rd, 2021, and we wanted to make a little video. There were some ongoings in the fixed income market and the equity market subsequently, and we thought it was a little bit of a complex issue. We thought it'd be good to bring a video to everybody to explain that. And with that, Josh, what is going on in the market? So tell me what's up.
Sure, thanks, Joe. We've seen some very unique, specific economic instances in the stock market and in the bond market over the last week or two, and they're a little difficult to really understand. We've had some people ask, "Hey, can you break down what's going on financially, what's going on economically, what's causing some of these kind of strange events to happen?" And that's what we're going to try to do today. So I think to get started, let's just kind of talk a little bit about what specifically is happening and then break down why. So what we saw the other day was the 10-year Treasury rate skyrocket and jump significantly and break through 1.5%, which I'll talk about why that
number. Where was it normally sitting at?
Well, last spring it was 0.6%, so It's more than doubled in less than a year. And that's caused some economic kind of waves in different ways. And it's not easy to really understand why. And so maybe we can kind of break that down a little bit. To start, let's frame some context about what's going on financially and economically to kind of get us here. And that is we're in this period of low interest rates when the pandemic started last year. The Fed dropped interest rates to virtually nothing in a proactive measure to keep the economy moving and help the stock market as well as the economy. And in between now and then, they've also infused trillions of dollars into the M2 money supply, which is up 26% in 1 year, which is the largest increase we've ever seen in the history of the money supply. So
ever in the history of ever, that's
right.
The largest. Okay,
including 0809, which, if you recall, back in 2008, 2009, there was QE, there was TARP money, and really what ended up happening was the Fed released all of this stimulus back in 08 and 09, but not all of it ended up in the money supply, meaning like spendable dollars. And most of it ended up in bank reserves, because at the same time, the government cracked down on banks' abilities to lend money. So a significant amount of that stimulus kind of just got like locked up and call it like no man's land in bank vaults. Relative to what's happened in this period of stimulus, which A, it's significantly more, and B, it was infused directly into the money supply through stimulus checks, through PPP loans, through small business lending. So that money's not just sitting in bank reserves now, it's in the money supply, meaning people can go out and they can spend it. So
kind of interesting, because we lived through 08, we lived through QE, which believe it or not, and I remember looking when we talked about like, wow, this money's not getting into that supply back in the day, and now we're running this experiment to see what happens when it's in the hands of small business owners and all the other Americans that got part of that stimulus package. So it's the same, like they say, it's the same, but it's different.
Oh, it's very different. In fact, the Fed was pretty adamant coming out of 08, 09 that inflation in their mind wasn't going to be an issue. And really, for all intents and purposes, it wasn't. We've had a very long period of moderate to low inflation. And if you kind of break down inflation, you can think of it as more people spending than supply. So higher demand with lower supply equals inflation. And that didn't happen after 08, 09 in terms of demand increasing, because that money really never kind of hit the money supply.
Never hit mainstream.
Never hit mainstream the same way that it has now. So
what do we got to watch out for? So obviously it looks like inflation might be something to look out for, but what are we looking out for? What do you think?
Well, I think what we have to look out for is a couple key things. One is if we just again continue to frame. So we are now in this period of significant inflow of money into the economy directly. At the same time as we're really on probably the red zone, the kind of the final stretch of this pandemic. We're depending on who you ask, and there's certainly a lot of controversy around this, but if we kind of take controversy out, we're very much getting close to a potential herd immunity. And if you break down the numbers between vaccines and between people who have actually had COVID and potentially have some level of antibodies, as well as we could be doing 2 million vaccines a day. It's very likely that we'll be in that 70 to 80% of immunities to reach herd immunities by April. And that will only continue to lead to more reopenings. In fact, what did we just see yesterday? Texas is literally opening up the doors, 100% reopening. It's very likely that we will continue to move towards herd immunity, move towards more people getting vaccinated, businesses continuing to reopen, and that's all good for the economy, right? Mm-hmm. And that's certainly good for businesses and for the stock market in general. But we got another $1.9 trillion of stimulus just literally getting dumped into the money supply, and I think the bond market is kind of saying, "Whoa, hold on a minute. Maybe this is indicative of inflation." Mm-hmm. That's the key here. Right. So the Fed has been very adamant that they have a plan to manage inflation. They're very confident in the fact that they can manage inflation, and they've set kind of inflation benchmarks and targets for what they're going to do to manipulate, really, inflation moving forward.
To make it palatable for all of us so we don't see this mega hike in inflation, which would severely affect lots and lots of people. It would affect everybody.
Correct. The bond market is essentially calling them out on that, saying you're not going to be able to do that. Interesting. And let's talk about then what the impact of that was, because we saw it we saw the impact of that for the first time. So let's talk economics for a second here. In theory, when let me actually take a step back. So what causes bond rates to go up? Because that's what we saw. We saw 10-year Treasury bond rates go up. Why does a bond rate go up? Bond rates go up when demand goes down. So when less people want to buy a bond, the rates essentially will go up to encourage people to buy them. So why would somebody not want to buy a bond? Well, if the bond market is saying we expect there to be more inflation later in the future, so we're confident as a bond market that inflation is going to go up. Well, what they're essentially saying is the Fed at some point, to combat higher inflation, will have to start raising interest rates. The Fed's been pretty adamant that they have no plan on raising rates this year, likely not even next year. But again, the bond market's kind of calling their bluff and saying if inflation increases the way that the bond market is expecting it to, that the Fed will likely or potentially raise rates faster. So if the Fed raises interest rates, that causes bond prices to go down. That pushes the value of existing bonds down. So you don't want to own, as a bond buyer, you don't want to own longer term bonds, because the value of those bonds could potentially go down if the Fed raises rates, right?
More aggressively. Yeah.
So when the Treasury auctioned off their 10-year bonds, the bond market was saying we don't want to own 10-year bonds because we expect interest rates to go up, which will cause bond prices to go down. So we don't want to own longer term bonds. So I just mentioned a moment ago, if nobody wants to own those bonds, that means lower demand. What happens? Rates go up because they have to incent people to want to buy those bonds. So if demand is down, if they raise the rates, that brings demand back up to reach an equilibrium where supply equals demand. So the rate shot up. And that was kind of a result of fear of inflation, which causes fear of rising rates, which pushes demand for longer term bonds down, which in turn causes the rates on those bonds to go up. Okay, so it's a widening of the curve, the yield curve in terms of time versus interest. Is inflation good for the stock market? They're not directly correlated, but there's no question that higher interest rates cause companies to have to spend more on interest. That can essentially reduce growth potential, and that can have an interest in the stock, or that can have an impact on the
Hurt
stock
the PE
market.
ratio, hurt your bottom line, hurts everything.
If the cost to borrow is more, then there's less profit, right? Nothing that is, out of the ordinary. Right. We've been in a very low inflation environment for a long time. We've been in a very low interest rate environment for a long time. That's very bullish, and the stock market has done well because of that. So I think it's just kind of this fear of, if we move too fast and if inflation starts to run and the Fed gets aggressive in trying to combat that inflation more so than they're saying, we could see rates increase faster, and that has some concern to some that that could have a negative impact on the stock market, and that's why we saw the market fluctuate.
That's certainly something to take into consideration as you're looking at your planning issues. So what are we assuming for inflation in your financial plan? What are your lending rates currently for your business or personal or what have you, if you were thinking about that refinance or any of those things? But obviously we're taking this into consideration with portfolio building, but there are some other reciprocal effects that could come from these potential moves by the Fed, or the widening of the gap, or inflation landing.
Sure, absolutely, and I don't necessarily think it's anything to be overly concerned about. I think most stock market valuations, when we take into consideration, really already higher than they've been. I think most valuations to kind of find like what's a fair value of the stock market right now have used Treasury rates at 2%, and like I said, last year they were 0.6%. Even now at 1.5%, give or take, that's still lower. I mean, the 2% valuation is still higher than where it is now, and at 2%, most economists agree that there's still room for growth in the S&P at 2%. The question, when you move past 2%, nobody knows. It's unlikely. I don't necessarily think that the 10-year Treasury will surpass 2%. Which is probably where it would need to go to see like a real impact, I think, on the stock market. Obviously, we don't know that for sure, but it seems unlikely that the 10-year Treasury would surpass 2%. And if it does, then it certainly would be cause for a reevaluation of like what the impact on that would be, specifically on the stock market. But there's no question it caused a ripple wave in the markets, and I think people are going to be watching this and seeing how does the bond market react, and then where does inflation go from here. The Fed is very, very adamant that they're going to try to maintain and manipulate moderate to low inflation levels moving forward. The question is, will they be able to? If they use the same rationale that they did in 08, 09, I don't know if that's apples to apples. But they're the experts, and certainly that's a big part of their job. So we'll have to keep an eye on that. We're still, relatively optimistic for 2021. We still feel that there's room for growth in equities, and we are certainly taking into consideration these components and making sure that we're doing everything we can, especially on the bond side, to ensure that we're doing what's necessary to keep our portfolios where we feel they need to be, given some of these very kind of rapidly changing factors.
Nice. Well, thank you very much. We wanted to keep these kind of short, so I hope that was useful for everybody that gets to watch this, hopefully. Thank you, Josh. That was very quick and insightful, and I think gave us nothing too major right now, but just some things that we might want to consider. And, bond interest rates, fixed income isn't always the most fun thing to talk about, but you really make it interesting and easy to understand. So thank you.
All right.
And thanks for everybody for joining us. If you like this, make sure you hit the like, subscribe, whatever, and engage with us at steinwealth.com. We'll see you guys next time. Thanks.